Portfolio Builder members, welcome to our January 9th, 2020 trade alert. We'll start off by auditing the previous trade alerts, which we're closing out today. Then take a look at our open positions, do a Q&A on the trade alert, and then I will deep dive into the analysis behind our current trade. So the setup that we had last Thursday was an inverted option caller on the TLT. And about half our members were assigned and have one result today. And the other half have a very similar result who were not assigned. So I'll start off assuming you were not assigned and go through the audit. And then we'll take a look at the little extra money you could have made if you were lucky and did get assigned. So we had a downward bet on the TLT from last Thursday through today. And it was a wild week. We had the attacks in Iraq and Iran, which did give the TLT a bid. And this caused the TLT to immediately jump after we placed a downward bet. And then after the fear was removed, we did have a significant sell-off on the TLT. To look at the point of entry, started at 137.12. And when we closed out the trade today, we were at 136.01. The position was a short 135 call. So that was an in-the-money call option we'd sold, and a long 138 put, which was an in-the-money put option. The initial cost of the option was a 98-cent credit. And when we closed this out today, we had an additional 83-cent credit. Now, this offset the decline in the TLT, which was negative $1.11. And generated a profit on the options of $1.81. So your net profit was 70 cents a share. And in our portfolio with 3,800 shares, that's a profit of $2,660. Now, if you were assigned, the math was slightly different. Many of our members woke up either Monday or Tuesday assigned. So what happened on that option assignment? Well, we had collected $2.50 on the option premium, selling the 135 call, which just pull up a chart so we can take a look at that. In fact, this is the trade alert, which is linked to in your email if you want to review. And so if we do look at the mathematics on this, we were agreeing to sell our shares for 135 by selling to open the January 10th 135 call. And we were willing to do this if paid a credit of $2.50. So when you look at the math on that, we essentially picked up a profit of 38 cents per share. And that's because we're taking a loss selling at 135 when it was worth 137.12. However, we picked up 250 from the option contract. So it's a net profit of 38 cents on the long side or the bullish side of the TLT. But this left you wide open with your put option. Now the put option started off with a cost of $1.54, and at the close of this trade was worth $2.04. So this gave you an additional gain of 88 cents and brought up your total profit to about $1.16. So a slightly higher profit if you were assigned. And in fact, that's what we hope for when we bet down, is that we do get lucky, get assigned, and then end up long our put option. Now, a lot of people do ask me, why do we not just purchase put options on the TLT? And we could, but that's a riskier setup. This setup actually generates a profit so long as the TLT travels flat or down. And that's because of the time premium eroding on the call option we've sold. Whereas if we just simply bought a put option, we have time working against us and need a big move to the downside. Otherwise, we start having considerable losses. So it's the big primary difference. Now, gold had a pretty big profit for us, but that did get wiped out today, unfortunately, with the de-escalation and the trade in the Iran-Iraq situation. Now this trade we initially put on 12/12/2019 with an in the money put option of $28 on the strike. And that put option cost us $1.15. So essentially this trade was expecting GDX to rise at a greater rate than the cost of our downward protection. And for quite some time it had. It was up over $1, but that did pull back today. So the net result of this trade is that we did see GDX appreciate 67 cents from 27.46 to 28.13. However, our downward protection for $1.15 offset that gain. As of closing out that position today, we did have 15 cents of value left, bringing our net return to negative 33 cents. Okay, I'm going to go ahead and look at the new trades, and then we'll take a look at our open position. So to reiterate how to get out of the previous trade, if you were assigned, you have to sell to close your put and then repurchase your shares. Now, if you were not assigned, you will still have your shares and you just buy to close the 135 call and sell to close the 138 put, which gives you that net credit of 83 cents on top of the dollar we initially collected. The new trade is very similar. We've adjusted the strikes and dates. We're selling to open the 133 call, which is another in the money call option. And we are buying to open the 138 put, both expiring January 17th. So this gives us a risk graph that's very similar to the previous, where we benefit from the TLT trading flat or down and actually lose money if it trades higher and remains higher through our expiration date. Now, this does give us that same opportunity to get assigned, generate a profit on the bullish part of this trade, and then be long our put option into next week. So we'll see if members get lucky again 2 weeks in a row. Otherwise, we do just fine as long as TLT travels lower. Now, our maximum return or approximate maximum return is approached as we get below the call option we've sold. So that's the 133 call. Now, I do see a hand being raised in the crowd, so let me grab that question before we go further. And Hector, I have unmuted you if you do want to speak. Oh, wait, let me. Yeah, did someone have a question? Okay, looks like false alarm on the question. If you do have a question, please let me know and I'll go ahead and mute the audience again.
Jason, I do have a question.
Oh, yes, sir.
GDX, are you anticipating that going down at this point?
Yeah, so let me jump into GDX now. So today's trade on GDX is the 29 put expiring February 28th. Okay, so as Oscar's pointing out, am I afraid it might travel lower? And so it's important to understand the difference between bonds and gold. They both seem to react well to fear, but perhaps for different reasons. So when I'm going long the bond market, that's because I'm fearful that growth is going to slow. And if growth slows, the central banks like to cut interest rates, which makes the value of bonds appreciate. And that's why we'd want to be long bonds if we believe growth is going to slow. Now, gold is a little bit different. Gold, we're really expecting for central banks to increase the money supply at a faster rate than the creation of gold, which is only created from being dug up in the ground. So as long as I believe the Fed is going to keep printing for the foreseeable future, I do want to be long gold. But that doesn't mean we don't have people playing on the fears and hopes in the market. So the big event that does make me concerned for GDX in the near-term future is the US-China trade deal being signed next Wednesday. So I think that could create some volatility. But here's the math on this trade so you can understand the setup, the risk reward, and what my intentions are for our gold position. So we've purchased the in-the-money put option, the 29 strike. So we have someone willing to purchase our shares for more than they're worth by buying the in-the-money put. So if we do look at our risk graph, you can see the maximum loss that we can achieve from this position is put on immediately. So we're going to go ahead and agree to the maximum loss the second we put this new trade on. And this is going to protect us until February 28th. So we won't have to adjust this put option until the 27th of February. And so if our maximum risk is $71 versus a buy-in cost of $2,810, what's that maximum risk look like on this position? And so you can see we're risking 2.49% of 10% of our portfolio. And what's our expectation? Well, clearly, I think that the risk to reward ratio is in our favor, because I do expect that kind of a domino effect. So the domino effect that is really causing all of our market predictions right now is, number one, we do have a clear schedule of the debt to be sold by the US government for the next year. And it's massive. The deficit is over $1 trillion. So that's part one. Part two is who's going to purchase this debt. Now, if it's foreigners who want to buy and hold the debt, that's great. And that would completely change our thesis here. But with the dollar weakening, this makes it more difficult for foreigners to purchase our treasuries. So they need to hedge against the dollar weakening on top of inflation expectations. So they're going to need a higher and higher yield on US treasuries to be able to afford the hedge and beat inflation. And so until we see foreigners actively picking up the bulk of our debt, we know who legally has to pick up this debt. And that's your primary dealers, JP Morgan. Okay, so if the US government is going to keep this deficit, which is something we can count on for the next, for all of 2020, and if we still need to see a considerable rise in yields before foreign investment will be highly attracted to US treasuries, then we can predict that the Fed is going to have to expand its balance sheet. And so that becomes extremely bullish for stocks as well as gold. And so we can go back to our GDX chart in 2000. Let me pull this up. So the last time we did some serious quantitative easing was at the end of 2008 after a series of rate cuts. So we just had the rate cuts in 2019. They're saying they will not cut rates any further, but they also won't raise them. In fact, now they're saying they won't raise interest rates for 5 to 10 years, which means this potential melt up in asset prices will go as long as they continue expanding their balance sheet, which will continue to grow as long as we continue to expand our federal deficit. But you can just see this melt up in GDX during a period of quantitative easing, which was primarily done in 2009, 2010, and 2011. At 2012, they did Operation Twist and officially stopped the massive QE. Got a little bit of stimulus in 2015, and now we're right back to QE. So that's why we want to be long GDX. The purpose of our put option is to remove the volatility in our portfolio, especially when we know that there's going to be this event Wednesday, which could cause some relief, although that's not really the calculation I'm using to predict an up move in gold. So if we can get more than a 2.5% rise in GDX between now and February 28th, we create a profit. But if we have any more short-term volatility, we're not going to feel any of it. The maximum loss is entered upon at this very moment. So we can't lose a penny more than we are currently because we're buying that $29 put. Also, that $29 put gives us some leeway to have some protection if we do start to get above the 29 strike and go higher. So does that make sense, Oscar, on the analysis on GDX?
Yes, sir.
So yeah, I love GDX, and I think we can, it depends on when they really do the full-blown QE and just keep in mind, although they are dressing this up as not QE because they're using repo operations and they're only buying the front end of the Treasury, the balance sheet's growing at the fastest pace in history. Now, the growth of the balance sheet last Friday was a little smaller, but we've seen more hiccups, more oversubscribed repo this week. So I would bet that this Friday and the next Friday, we should see some pretty healthy or unhealthy growth rather of the balance sheet. So that's as simple as it is for GDX. Yeah, we still see gold have some reaction to things like war and things of that nature, but really just look at 2009 through 2011, everything was gravy and GDX went up alongside stocks. So that's the reason for being long GDX. And so if we can buy a put, an in-the-money put, lock in our maximum loss at 2.5%, divide that by 10, we're risking 0.25% of our portfolio, a quarter of a percentage point, to have exposure to potentially the best performing asset class for the next several years. So my expectation is that GDX will be the top returner when QE is aggressively ramping up, which could be this year. It might be 2021, but it could be this year. So we have to keep a close eye on that. Then I think emerging markets, then the SPY. And at the same time, we have a short-term opportunity to make some very handsome profits from TLT selling off rapidly. Now, I think we're getting a little bit of a bid because now we have data that the Iranians blew up 170 people in that airplane. So we don't know what the ramifications of this will be. But the big picture here is just really overwhelmingly that long-term yields need to rise until we have a crisis. Okay, so let me pull up our two trades. So again, we're back to the same trade as last Thursday on the TLT. Did move the call option a little bit lower than previous, which can help us boost the profits. So we can make a rather large, now that I am seeing the price action on the TLT, I've gone a little more aggressive than the previous trade. So again, my expectation is this can only go to around 120 before it starts to cause havoc on stocks because those yields get so attractive that it causes money to flow out of stocks into bonds with the expectation that there'll be rate cuts. So we'll see just how fast the TLT pulls back. It's not going to be an instant reaction. I think we'll see the stock market rally up aggressively as the TLT falls aggressively. And then as those yields get more and more attractive, it'll slow down the growth of the stock market and slow down the growth of bond yields. until we get to a pivotal point in the markets. Okay, got a lot of people joining in. Welcome everybody. So that's our TLT trade, and again, GDX. We're preparing for some volatility because we have some excellent news potentially with the US-China phase 1 trade deal coming out Wednesday, where they will sign. I think that could give us some downward pressure on GDX. But again, the big picture is that the US government's creating a massive deficit. The primary dealers are having to pick up the tab. This is causing the banks to have no capital to lend overnight, which is forcing the Fed to do these massive repo operations. And that in turn expands the balance sheet and gives you this big bull market in stocks. So once again, we're entering a maximum loss with this in the money put. And that's because the strike is above the trading price. So we cannot lose a penny beyond what we're paying for this downward protection. And that's about 2.5% of the total value, or 0.25% of our total portfolio. All right, I'm gonna go ahead and see if we have any questions before we continue, guys. The next part will be analysis of these markets. But that's the big picture. As long as the government wants to spend $1 trillion more than it collects, throw in a few natural disasters, that deficit gets a lot bigger than $1 trillion, like clockwork. Okay, we got a question from Mark Stoley. Let me go ahead and unmute you. Thank you. If you want to, there you go.
Yeah, can you hear me?
Yes, sir.
Okay. Let's see. So I'm sorry, I got in late. I mean, in other words, I just got here.
Yeah,
and
no worries.
So I'm looking at the GDX alert that you sent.
Okay.
And I'm a little bit confused. It's sell to open Jan 133 call, buy to open Jan 138 put. And then the next instruction is sell to close the Jan 28 GDX put and buy to open. So we've got a buy to open in the second group of instructions. So you've got opens in the first group and then close in the second group, but the close and open are together in the second group. I'm confused by the formatting, or maybe it's just me not thinking it through yet.
No, you're good question. So let me just walk you through. So Thursdays are tough because you have to deal with 2 trades in one. So step 1 and step 2 are related to the TLT.
Yep, that one was clear. I got that one, no problem.
Okay, great. So step 3 and 4 are related to GDX. Now, did you take the previous trade?
Yeah, I did. Let me look at what I have for GDX. I just have the shares and the single put, the
Okay,
Jan
good.
28 put open.
Yep.
That's all I have.
Okay, good. So you sell to close your put and then buy to open the new put.
Okay.
And we're going to be done with that position till February 27th. So by buying the in the money put, it gives us a lot of protection until February 28th when it expires. So we won't touch that position again until that date.
Okay, I see what I did. I accidentally put the TLT part under the GDX part. Just the way you have it formatted, I accidentally grabbed that last sentence from the TLT and thought, I was thinking in my mind that was part of the GDX. So my problem, my fault. Sorry.
No, hey, no problem at all. So good question. Okay, great. I'm going to go ahead and go to any other questions out there, guys, before I go into some analysis. Okay, great. I'm going to go ahead and share my iPad now where we have it decked out for today's content. Gotta love this technology. There's no way I could put this all together without all the. Okay, let's see. We're sharing. Mirror. Okay, great. Do we have good audio or visual, guys? Do I have to?
No, not yet, Jason. It's showing like, there you go. All right, now it's good.
Okay, great. Okay, cool. So now we're going to take a look at some more analysis. But again, the big picture is once again, government's creating a massive deficit and foreign investors don't want anything to do with it because the dollar is weakening and they don't actually create a profit once they take away inflation and the cost to hedge against converting it to their own currency. So we have a period of time.
Well, sure. They can't hear me.
Let's see if I mute that. Okay, good. We got everybody muted. Still got a good audio, visual, Dean? Yep.
Yes, sir.
Okay, great. So we're going to look at some analysis. This is Jeffrey Gundlach's favorite indicator for, he's got a bunch, but this is one of them. So here's the interpretation. Gold is the most widely recognized safe haven asset among investors. Therefore, during times of economic and geopolitical distress, it generally tends to perform well, making it a leading indicator of fear. Copper is the exact opposite because it's a key industrial metal that is used globally in a wide range of industrial applications. It performs strongly when the global economy is firing on all cylinders. This makes it a leading indicator of global economic health and has led to it being commonly called Dr. Copper, the ratio of prices, copper and gold. And it represents the number of ounces of gold it takes to buy an ounce of copper. Okay, so here's our ratio. And you can see ever since we began the QE in September, the ratio has been rising. And we've seen a lot of different charts and analysis of this, but the bottom line is when the Fed is cutting rates, we get yields to obviously drop and TLT goes up. But once they stop cutting rates and go to almost any form of quantitative easing, then we're seeing yields rise. And so we can see the second they stopped cutting rates and went into quantitative easing, this ratio has been on the rise. Now we've had a little bit of a sell-off in that ratio, primarily from gold jumping to 1,600 an ounce. Gold bugs are, Peter Schiff is one happy camper right now. Here's a look at gold versus copper in percentage terms. If we do zoom out, we can see they do travel together, just not always at the exact same time. And so this would indicate that copper should jump up and catch up to gold. Rarely do they travel in opposite directions. So for our boot camp members, you know we have a very good copper position in two top copper companies. I probably have a little more insight into that now. Also, it's highly correlated to interest rates. So we have the 10-year Treasury down below. And if we look at the short term, it's not as obvious. You can see in the short term, due to the panic in Iran shooting the spot gold up, we have a little bit of a short-term indicator stating that yields might go a little lower, which we did see that, what I would call head fake last week. But once we do zoom out, we can see that that the Treasury rate most likely will catch up to where that ratio is, and that's significantly higher. So this is one of the best indicators there is for predicting the 10-year Treasury. So that's the first chart I wanted to look at. And again, you know, this is something that's useful, but it's not really the source of the reason. It's not the fundamental reason why. This is more like, you know, checking your heart rate or your blood pressure. It's a good indicator, but it's not the source of the problem. Source of the problem is the debt from the US government causing all of this. Next thing I'd like to do is look at our Treasury curve. Let me get a refresh. Okay, so let's go back to the beginning of 2019. We had a great rally in stocks and bonds. And you can see during this period of time, the Fed was cutting rates. Let me try to zoom in on that for us. Okay, so let's just explain what the heck we're looking at here. On the x-axis, you have the duration of the Treasury. So 1 month, 3 month, 1 year are your T-bills. 2 year, 3 year, 5 year, 7 year, 10 year are your notes. And then your 20, 30 year are your bonds. Now the TLT is very popular because it only buys the 20-year and 30-year treasuries. So it's something like having a 20 times and 30 times leveraged instrument. So it's a highly leveraged instrument when we're playing a change in yield prices. So that's why the TLT is so popular. There's others. In fact, they have a TLT for each spectrum of the yield curve. And certainly you could be an expert just at the different parts of the yield curve. For our portfolio, we get the best bang for the buck with the TLT. And so what I want you to note is that during a period of rate cuts in 2019, we saw yields drop, which makes the TLT go higher. Okay, but eventually this started to cause distortions. And ever since September, when they had an emergency meeting, they stopped cutting rates and went into quantitative easing. And let's just see what's been happening since that period of time. And so with quantitative easing on the front end of the Treasury, they're only manipulating the front end. I do see some questions. Have a great day, Oscar. We'll catch you tomorrow. So as we can see in this chart, let me get off that one data point. What's the Fed been up to? Well, they haven't been buying your notes or your bonds. They've only been buying the front end of the yield curve. And that's because it went inverted. You can see on the turquoise line, this one right here, this is when the yield curve went severely inverted. And this is a big no-no, messes up the way banks loan money, among other things. But if we can get 1.91% on a 1 month yield, but we can only get 1.56 on a 3-year yield, that makes no sense. So what did the Fed do? Well, they came in and they started aggressively buying the 1 month, 3 month, and 1 year T-bills. And so what happened? The yields on those dropped and everything else began to rise like clockwork. This happens every single time without fail. That is really the big prediction here, is as long as quantitative easing continues and it's done at the front end of the yield curve, then we can expect that this will continue to rise until the Fed has to act. Let's go into January now. Until the Fed is forced to act. What will their reaction be? Well, most likely they'll wait for stocks to crash, and then they will start cutting rates. And what will that do? Now it'll drop these yields back down and allows the bankers who are buying up the bonds to get out for a big profit. So they do this over and over again, and that's our expectation. Okay, so that's a look at the yield curve. Let's take a look at some other, so that's a big picture on the US markets. What about other markets? Here's another different way to look at it, not as a yield curve. Now here's your big picture. Let's just look at the last year, even the last 6 months. Okay, so we have in this chart, we've selected the 1 year yield in green. Let me reset this for us. Okay, so here's your 1 month yield going back let's go back 1 year. So we can see that this yield had dropped for most of 2019 as they cut rates, and then they went into QE. And the immediate reaction in September, even on that 1 month yield, was for it to begin rising. And that's when they had to step in and start to artificially keep these three right here artificially lower. Okay. But what happened to the long end of the curve during this period? And we can see it is rising as they're only manipulating the front end of the curve. So it's just another way to look at the same data from another linear point of view overlaid. Okay, but what's going on in other debt markets? Here's a look at the German yield curve. This is somewhat of a good leading indicator for US Treasuries. It also gives us a barometer of what's happening in China. And so if China is slowing down, we can expect Germany to drop interest rates to try to spur growth. And if growth seems to be recovering, then they'll leave their rates most likely alone and just fuel the growth with some quantitative easing. And so we can see 1 month and 6 months ago where these yields were, and same picture, yields are rising, which means TLT goes down. How about in Japan? From a 6 month look back, yields are clearly rising in Japan, who has one of the largest bond markets in the world. What about in the United Kingdom? Well, they actually are trying to break, well, they did Brexit. And this is one of the few where we don't see that trend, where yields have actually dropped slightly from 6 months ago. How about France, which was not part of Brexit? Well, from 1 month ago, yields are rising. From 6 months ago, not quite so much. Spain, very little change. Now keep in mind, Spain, France, Italy have some of the biggest problems economically. Netherlands, another big debtor. And we can see their interest rates are indeed rising. And again, the blue line's current, the green line is a month ago, and 6 months ago is your yellow line. How about in Italy? Italy having trouble, and that's why their yields are going slightly lower. Canada, yields are indeed rising. How about Australia? Another look into a core country connected to China. And from 6 months ago, it's lowered, but from a month ago, it's back to rising, confirming our outlook on China, which is that we don't want it to be crashing. If it's crashing, all yields worldwide will drop once again. Okay, now we're looking at Switzerland, another big bond issuer. And from a month ago, its yields are rising. However, from 6 months ago, they had dropped. And Switzerland was actually one of the first to do a rate hike most recently after being in negative yielding bonds, which could signal a shift in central bank policy. All right, so that's a wrap up of our review of what's going on in treasuries. Quite a clear path. Only thing that could derail this would potentially be, let me get back to my computer screen here. So what could go wrong? Well, sure, if the issues in Iran were to escalate, that could cause some trouble, but I don't think that will be the case. If the US-China trade deal failed to be signed and we did escalate, that would probably be the core problem. And if Bernie Sanders looks like he's going to win the election, I think that's another core issue. If the Fed stopped growing its balance sheet, that could become an issue. But other than that, this looks pretty clear cut for us until we get some higher yields. So I think the next few months should be relatively easy to predict for the TLT. And we know what to watch, which will be that Friday report on the balance sheet growth. So that'll be our, that data is released at 2:30 today, and we'll be covering it first thing tomorrow to ensure we are on track for expanded balance sheet and no change in interest rate. All right, guys, I'm gonna go ahead and open this up for Q&A once again.
Okay, guys, let's open a Q&A.
There's not a lot of people that sign.
Okay, any questions out there today? Now, Mark, do you have another question? I do see you have your hand muted or your hand raised.
No, I'm sorry. I left it raised from before. I forgot to unraise it.
Okay, no problem. Well, any other questions out there, guys, or should we let Dean do the close?
MG, MH, I have no idea who you guys are. Please feel free to unmute your microphone and let us know who you are. And please, any questions at all, we would love to address them for you.
And so we are at a nice return early on in January, up 0.4%. Oh, we didn't look at our open positions. Let me do that really quick. Those are both up. So emerging markets is up 48 cents since we put on the trade Tuesday. And again, we're having to work off a put option, which currently has lost 17 cents against a 48-cent return, giving us a 31-cent profit per share, or $1,178 profits on our emerging markets position. SPY is up $1.46. Again, we protect from downside volatility. That option caller was financed for free by selling a call. So currently it would cost 46 cents to exit that option caller. So we're up $1 or $1,900 on the SPY. So again, the big picture here is we're trying to generate return with very little risk. All right. Well, I think that's what I have for today's presentation. Dean, did you want to add anything in, or?
Sure. Let me just get that control here, and then we'll...
Okay, I'll make you the host.
Okay, sounds good. So yeah, MGMH, I'm not sure who you guys are, but please feel free to go ahead and reach out to me. Let's definitely set up your free investment analysis with me. Would love to do that. Basically, what we're going to do is just look over your portfolio, see if there is any malinvestment. Typically, see if maybe there's some under allocation to the market. I can find that a lot of the time as well, and just just overall see if there's a way I can help with a quick phone call, and just see what you're doing to protect yourself from downside. See where you're doing well. See where you're struggling in the market, and just see how we can help. So there's no cost to do it, folks. And my number is 505-322-7515. Thank you all for joining us here today, and that will conclude our presentation for today. Call me if you have any additional questions. Be happy to work through those with you. Have a wonderful day, folks. Thank you for your time.